Welcome to the Explainer. Today, we are going to crack the code on currencies. We're going to find out what really drives the value of money across borders, and believe me, it's a force that shapes, well, pretty much everything, from a single business deal all the way up to the health of the entire global economy. Okay, let's dive right in. Imagine this. You run a business, and you need to buy a ton of steel. You've got 3 quotes sitting right in front of you. Seems simple enough, right? Just pick the cheapest one. But there's a little catch. And here's the catch. The prices are all in different currencies. You've got US dollars, British pounds, and Japanese yen. Right now, you're basically comparing apples to oranges to something else entirely. So to make any real decision, you've got to get them all speaking the same language, financially speaking. You need to convert them into a single currency. All right, let's do the math. We'll start with the British supplier. So let's say the exchange rate is $1.65 for every pound. A quick calculation, and that steel costs you $191.40. Suddenly that American supplier is looking a little better. But hold on, we're not done yet. We've still got the Japanese supplier. Now, if the exchange rate is 110 yen to the dollar, you take their price, that's 20,000 yen, and divide by 110. And what do you get? Just $181.82 a ton. So, there you have it. The Japanese supplier is the clear winner. And this really simple example just goes to show you. Exchange rates? They aren't just some abstract numbers you see on the news. They have a huge, direct impact on real-world business decisions every single day. And by the way, making these international deals happen often involves some pretty specialized financial tools. Things like letters of credit, which basically guarantee that everyone gets paid. Okay, so that's one deal, but that gets you thinking, right? If we can track the money for one single business deal, how on earth do we track all the international transactions for an entire country? I mean, we're talking trillions of dollars. Well, there's a system for that, and it's called the balance of payments. The easiest way to think about it, it's like a massive national checkbook. It keeps a record of every single transaction between one country and the rest of the world, tracking every dollar, yen, and euro flowing in and flowing out. And we can actually simplify this big idea even more. Think about a family's budget. You have income, like a salary, and you have spending, like groceries and rent. A country is kind of the same. It has credits, that's money coming in from exports and investments, and it has debits, money going out for imports. And just like a family that spends more than it earns runs into a deficit, well, when a country imports more than it exports, that's called a current account deficit. And believe me, the scale of these financial flows is just staggering. Take a look at the U.S. balance of payments for 2009. The big number to focus on here is the current account deficit. We're talking over 378 times billion dollars. To put that in perspective, that means the U.S. bought that much more stuff from the rest of the world than it sold to them. And this wasn't just a one-year thing. This chart here really tells the story. It shows the trend over almost 30 years, and you can see that deficit just ballooning, especially from the late 90s on. It points to a really long-term pattern of the U.S. buying more from the world than it sells. So all this talk about deficits and exchange rates, it kind of leads to a really fundamental question, doesn't it? Is there such a thing as a correct price for a currency? Some kind of natural value that it should always be moving towards? Well, one of the most famous theories out there suggests we can find a clue in a very, very unlikely place: a global fast food chain. That's right. We are going to talk about a hamburger. The theory is called purchasing power parity, or PPP for short, and the core idea is actually pretty simple. It says that over the long run, exchange rates should naturally adjust so that your dollar or your pound or your yen can buy the exact same amount of stuff, no matter where you are in the world. Basically, an identical product should have one single global price. So, to put this whole idea to a fun, real-world test, the magazine The Economist came up with something brilliant: the Big Mac Index. I love this. Since a Big Mac is pretty much the same everywhere you go, they use it as a simple yardstick to see if currencies are trading where they should be, according to this PPP theory. So, let's look at what they found. According to the index, if you bought a Big Mac in Sweden and converted the price back to US dollars, it would cost you a whopping $6.56. What does that tell us? Well, according to the theory, it suggests the Swedish krona is overvalued compared to the dollar. Okay, now let's hop over to Hong Kong. There, the same burger costs the equivalent of just $1.90. So the theory would say the Hong Kong dollar is undervalued. Now, this is a really fun way to see the theory in action, but we have to admit it's not perfect. Why? Well, PPP doesn't account for a lot of local costs, things like labor, rent, taxes, import duties. All that stuff gets baked into the final price of that burger. So, PPP is a pretty good guide for the long-term trend, but it doesn't really explain why currency markets are so volatile day to day. In the short term, there are other, much more powerful forces pushing and pulling on those exchange rates. And three of the absolute biggest drivers you need to know about are capital flows, relative inflation rates, and good old government intervention. Let's talk about capital flows. Picture this. A country hits a rough patch, maybe some political or economic instability. What do investors do? They get nervous. They pull their money out and move it somewhere they think is safer. This is called capital flight. And all that money floods out, often into huge, mostly unregulated markets like the euro currency market. And what happens to the home currency? Its value just plummets. Inflation is another massive one. I mean, think about it. If prices in your country are rising way faster than everywhere else, your stuff becomes more expensive and less competitive on the world stage. So demand for your exports goes down, and so does demand for your currency. It's a pretty reliable rule. Over time, high inflation almost always means a weaker currency. Okay, we've covered a lot. Trade balances, Big Macs, capital flight. But let's bring this all back home. What does any of this actually mean for you? You know, when you hear on the news that the dollar is strong or weak, why should you care? Well, as you can see, there is no simple good or bad answer here. It's all about trade-offs. A strong dollar? That's fantastic if you're buying stuff from other countries or planning a vacation abroad. Your money goes way farther. But it's really tough on American companies trying to sell their products overseas. And a weak dollar? It's the complete opposite. It helps out U.S. exporters, but it makes that new phone or that trip to Europe a lot more expensive for you. So at the end of the day, this really isn't about good versus bad. It is a constant, delicate balancing act. What the ideal value of the dollar should be is a huge, politically charged question. And the answer? It totally depends on who you ask. Are you a consumer buying stuff, a factory owner trying to export, or maybe a central banker trying to manage the whole economy? So from a simple choice between steel suppliers to a nation's entire economic strategy, all the way to the price of a hamburger, these invisible financial forces are constantly at work, shaping our interconnected world. Hopefully, the next time you see one of those headlines about currency values, you'll see the complex, fascinating story that's really hiding behind the number.